Okay, we are recording. Let's share the proper screen. And let's start the conversation. Welcome to Unit 4. I'm hoping to cover section C and D with this video. It might be kind of a long one. We shall see. This is in the money-making section of the money-making chapter, I should say, or something like that. Can't quite remember the exact phrase. Whatever. Let's get into it. We're going to talk about savings plans and investments, the basics of the math behind different investment strategies, and sort of the idea. We're going to start out with this fun-looking equation, the savings plan formula for regular payments. It involves making a regular payment into a savings plan at your bank or your credit union, what have you, and the amount of money accrued based on the interest the savings plan pays out. This, on face value, looks like a very complicated equation. I understand that. However, I'm going to stress the order of operations as I have before. PEMDAS, please excuse my dear Aunt Sally. And if you take a large equation like this, chop it up into its smaller bits, and solve it in a stepwise fashion, writing down what you do, as we've talked about in class previous many times, you will find these equations to be rather easy to solve. Notice we have 5 different variables. We have A, which is what this big thing equals to, which is the accumulated savings plan balance, how much money you have into it. And that money is based on your regular payment or deposit amount, your PMT, which is, I'm going to put $100 a month into my savings plan. That would, PMT would be 100. Your APR, which is your rate, your annual percentage rate as a decimal, given your savings plan, it'll tell you that. Number of payment periods per year is N, and number of years you're doing this payment strategy is Y. So again, this should look familiar from previous equations. I understand if it's daunting at first, the more you use it, the more you find out this equation is not complicated. Let's use that as an example. We're going to use the savings plan formula to calculate the balance after 6 months for an APR of 12%, monthly payments $100. So what does that mean? I have a savings plan with an APR of 12%, and then for 6 months, every month, I'm going to deposit $100. If I do this, after those 6 months, what will the balance in my savings account be? It'll be $600 plus whatever interest has been accrued in that time. So we take our information, we plug it in this equation. Again, APR was the 12%, so we convert it to decimal 0.12, plug it in on top. N is 12, right? Because what we're going to do is we're depositing monthly. So N is the amount of times you deposit in a year. We're depositing once a month, we deposit 12 times. The kicker here is the Y. Y is the amount of years we're doing this, the capital Y up there in the exponent. Y is 1/2 because we're only doing this for 6 months. 6 months is half a year. So that's where that 12 times 1/2 up in the exponent of the numerator arrives from. Run through this math. Again, not difficult if you take it in stepwise fashion, which is this third section down here. This bottom part is solving all the individual parentheses first. And what we find is our $600 deposits accrued $15.20 of interest. So simply by having this savings account, we have made $15.20. So basics of the math, let's go over some definitions. First of all, annuity. You've heard that phrase before on commercials, what have you. An annuity is any series of equal regular payments. If you get an annuity, you are getting paid something. Technically, if you're putting $100 into your savings account, that's an annuity. An ordinary annuity is a savings plan in which payments are made at the end of each month. An annuity due is a plan in which payments are made at the beginning of each period. And those obviously are different timings. They're money terms because annuity is the payment. So we got to have our own special language here. Future value of an annuity is the accumulated amount at some future date. That kind of makes sense, right? And the present value of an annuity or savings plan is a lump sum deposit that would give the same end result as regular payments into the plan. So present value is present value. Let's take these ideas, do a question with them. You would like to retire 25 years from now and have a retirement fund which you can draw in an income of $50K per year forever. So after you retire, you will have an income of $50,000 to spend as you wish until you die. How can you do it? Assuming a constant APR of 7%. Well, so by how you can do it, that means how much money do you need to have in your retirement account such that you can draw out $50,000 a year and not end up running through your retirement account. So what balance do you need to earn $50K a year from interest? If we assume a 7% APR, well, that's pretty easy to figure out, right? 7% of what is 50,000? So our total balance down here, divided by 0.07, find out that you need $714,286 in your retirement account in order to live on $50K a year. So let's assume you will try to accumulate a balance of $715,000 by making regular monthly payments into the savings account with that APR of 7%. You're going to make monthly deposits, so you can do 12 deposits a month, and you're going to deposit that for 25 years. How much do you need to deposit to make that happen? Well, as we've said, you follow the equation here, but in this time, you solve it for payment because the question you're asking is what payment do I have to make? Because I know the amount at the end is going to be $715,000. So we're going to take our equation that we talked about at the beginning, this equation, and we're going to rearrange it so that we're solving for payment. And if you're not on top of rearranging equations, write down this equation now here for homework, tests, what have you, that is solving for payment given an amount. Plug in an information. Year is 15, N is 12, right? APR is 0.07, what have you. And what we find out is you need to deposit $882.64 every month in order to, by the time you retire, have $50,000 a year of spending money. That's a lot, right? Have $882 just to put away in savings, expensive, right? Not everyone can simply start a savings account and build it to the point to where they can retire and just live off of their savings. So let's move on, talk about a couple other topics here. Total return. Let's consider an investment that grows from an original principal P to a later accumulated balance A. The total return is a percentage change of the investment value, or how much money you've made in A given P. It's a simple percentage here. Subtract the two out. This should look familiar from previous chapters, right? Your annual return, however, is the growth from the original principal to a later accumulated balance A in Y years. So your annual growth is your annual percentage yield, your APY, given that same overall growth we talked about previously. So your total return is at the end of it all, and your annual return cares about the years that you're talking. You invest $3,000 in a Clearwater mutual fund. Over 4 years, your investment has grown to a value of $8,400. What was your total and what was your annual return for those 4-year periods? Well, your total return is, again, how much money you made based on how much money you originally spent. You put in $3,000, you got out $8,400. That is a gain of 180%. That $3,000 made you 180% profit. However, you take into account the years it took to do that, 4 years. Do this math out here. Notice the exponent 1/4 is the same thing as the fourth root of the number. If you're not excellent with roots in your calculator, you can just exponent 1/4, same idea. We notice here we got about 30% per year growth. Again, these equations may look complicated, but if you take the time to slow down and write everything down, you'll find this math is not super, super difficult. So let's talk types of investments. First of all, we have stocks. Stocks give you a share of ownership in a company. You invest some principal amount to purchase a share of the company, the stock, and you get money out if you sell the stock. If you do not want to be a part owner of that business or company anymore, you can sell your stock to someone who does want to be a part owner. And hopefully the business has grown since you bought that initial stock, so the stock's worth more, so you make money. Stock prices, of course, change over time. So a sale may gain you a net profit or loss based on the original investment. If you work the stocks, if you've seen any movie about a stockbroker, right? Buy low, sell high is the idea here. Bonds represent a promise of future cash. By buying a bond, you are paying some principal amount to an issuing government or corporation, and the issuer pays you a simple interest, which we talked about in previous sections, and then pays you back your initial investment at a later date. Bonds are in the same family as the stock, but are very different. Usually when I say bond, I'm referring to a government bond. That's what most people would probably think of. You can get bonds from corporations and businesses, but stocks are more exciting. More people like to do stocks. And then technically a type of investment is cash. Cash investments generally earn interest and include money you deposit in a bank account, CDs, sort of certificates of deposit, treasury bills if you want, and things of that nature. So overall, many different types of investment. This class, as you know, as you've been taking it, right, is not necessarily a finance class. This chapter 4 is a quick overview of the math behind finance. All this stuff is much more in depth. If you're interested, take a look on it at your own time. So let's talk investment considerations. Liquidity is a word you hopefully have heard before. Liquidity is how difficult it is to take out your money. How liquid is that finance? If you want to sell your stock, how easy is it to sell? That would be the liquidity of the investment. The risk is, well, the risk, if you're going to make money or not. And the return is how much profit or technically how much loss you're going to have on your investment after the fact. All three of these are important to consider, return being just the pure money, risk being how confident you are in your return being positive, and liquidity being if I want to sell my stock, how easily, or if I want to profit off my investment, how easy is it for me to do that? As we both know, stock markets follow trends, as this is shown here. By definition, a stock is supposed to rise. The Dow Jones Industrial Average is the average price of 30 different large companies. It changes as it goes, and as you can see here, it grows dramatically. Notice right around 1930, a big drop. That is the Great Depression. We had one in 2009. That was the housing market crisis. We had one around 2000. That was the dot-com bust, things of that nature. But it just continues to go and grow. Stock market is a big news point as of recording this video, given the COVID-19 pandemic. So this may be timely or not, depending on when you watch this video. All right, let's talk stocks a bit more. In general, there are two ways to make money on stocks. The first way, as we talked about before, is to sell your stock for more than you paid for it. You have a capital gain on your stock. I bought my stock at $10 per share. Company did very well. I can now sell my stock at $50 per share. If I had 100 stocks, I've made quite a lot of money, right? Early investors into Microsoft, Google, Amazon, things of that nature profited huge off of this policy. The second way you can make money off of stocks is by a dividend. What a dividend is the owner of the stock, to the owner of the stock, a corporation distributes part of the profits back to them. If the company does very, very well, the corporation, the company wants you to keep holding your stock, so they essentially pay you to keep holding it. Dividends only really come out of profits, and it is a way to show the share. There's a way to keep your shareholders essentially. I'm going to suggest you take a second, look at this, pause the video, and understand each of these individual components. I'm not going to go in depth into them now, but there is a lot of information about stocks that look complicated at first, but if you understand what's going on, it could be much easier to follow. So just take a second, pause the video, look at each of these examples, and then we'll go through a actual on-time example of this. So, understand a stock quote. 5 questions here. Again, pause the video, try to answer each of these questions and your piece of paper, your notepad in front of you, and then we'll go through them and we'll talk the answers. So first of all, I want you to look up and tell me the symbol for Microsoft stock. Then I want to know what was the price per share at the end of the day yesterday. And again, we are in the middle of a COVID-19 pandemic, so that number may not be too impressive as of recording this video, but future watchings, these numbers always change. Based on the current price, was the total value of the shares that have been traded so far today? Once you know that, you can answer what fraction of all Microsoft shares have been traded today. And then finally, suppose that you own 100 shares of Microsoft. Based on the current price and dividend yield, what total dividend should you expect to receive this year? So hopefully you had already paused the video, done this work yourself. Now we can talk. Shown in the top of the quote, Microsoft stock symbol is MSFT. Cool. The quote, as of again recording this right in the slideshow, the quote shows the current share price is 1976 and the change of 13 cents. Means that, right, the price of the stock dropped 13 cents from yesterday to today. So yesterday, a stock in Microsoft was 1989, and today it was 1976. Again, this is as of recording this video. Hopefully, when you did this information, when you looked this up yourself, you found more relevant modern information. The volume shows that there were 33 million and some number shares of Microsoft stock traded today. At the current price of 1976 per share, the value of these shares turns out to be around $657 million. So the total value of shares traded today for Microsoft had a value of $657 million. $657 million exchanged hands just in the day of writing of this particular question. That number is probably larger, it might be smaller, but it's probably larger when you looked it up yourself. The value of the shares outstanding, quoted in millions, shows a total of 8899.72. So the actual number of shares that exist for the company is 8,899,720 shares. That's how many shares exist of the company. So 33 million shares were traded as of the writing of this video, or about 0.37% of Microsoft's shares exchanged hands. At the current price, if you owned 100 of those, which again, 33 million shares were traded, you owning 100 really isn't that big of a step there. But if you owned 100 shares, you'd have a little under $2,000. Given a dividend yield of $2.61, you could expect to earn a little over $50 in dividend payments, according to prices as they sat at the recording of this slideshow. When you did this information yourself, you probably found these numbers different. If they were different, feel free to comment down below your thoughts and opinions on that. Have a conversation with your fellow classmates. Cool. Bonds. We talk stocks on stock bonds. Bonds are issued with 3 main characteristics. Those being the face value, or the par value, but the face value, which is the price you pay the issuer to buy the bond. The coupon rate, which is the simple interest that the issuer pays you. And the maturity date, which is the date that the issuer will repay you the face value of the bond. The current yield of a bond is given by the annual interest payment over the current bond price. Example here is the closing price of a U.S. Treasury bond with a face value of $1,000 is quoted at 105.97 points for a current yield of 3.7%. Let's say you buy this bond. How much annual interest should you receive? Again, my suggestion, pause the video, work the question. When you're done with the question, come back, check your work. So we have a $1,000 treasury bond quoted at 105.97 points, meaning that bond has a current price of 1,059.7. Given a current yield of 3.7%, we should expect to make an annual interest on this bond of a little under $40. Spend $1,000 now, get $1,000 back later, plus $40. Not too bad. Mutual funds. Same as before, bit different, right? Comparing mutual funds, most important factors when looking at these are the fees charged for investing, usually not shown on most mutual fund tables, how well the fund performs, and on top of all the other things you need to worry about with prices, liquidity, things of that nature. Mutual funds, of course, do not have any guarantees going forward. Just as with, well, anything technically, but there is more assurance than, say, a bond than a stock, but yeah. Mutual fund quote shown here. Again, pause the video. You hear me saying that a lot. Take a look. Make sure you understand what's going on with all this information. Hopefully you can understand it, given what we've talked about so far in class. And let's take that Vanguard 500 mutual fund quote as an example. How many shares will you be able to buy if you decide to invest $3,000 in this fund today? Well, given that the current share price is $222.21, you can buy 13.5 shares, right? Divide it out. Pretty straightforward. All right, last section of this chapter, Unit 4D, loan payments, credit cards, and mortgages. Fantastic. Let's talk some basics of loans. Ooh. A loan speak is, as with everything in this class, slightly different than regular conversation. The principal, for example, is the amount of money owed at any particular time. When you take out a loan, the amount you have to pay back to the bank before you're done paying it back is called the principal. An installment loan or a amortized loan, you will become familiar with these as you dive into this terrible pond, is a loan that's paid off with equal regular payments. Don't know if you can have many loans that do that anymore, actually. Lots of loans change payment schedules. Well, I don't know. Actually, I'll take that back. I'm not going to say loans regularly change payment schedules. I will say that not all loans are amortized. The loan term, of course, is the time you have to fully pay back the loan. That makes sense. This equation shown here should look somewhat familiar to you, right? It should look a lot like the savings account and the stock accounts and all the other equations you've seen. That includes a payment amount, a starting principal, which is the same as the amount that we talked about before. If you look at these two equations side by side, an APR, a payments per year, and a loan in years. However, they look different. They are not the same equation. Keep that in mind. If you're talking savings accounts where you accrue money versus loans where you pay money, you have two different conversations going on there. Principal and interest for installment loans. The portions of installment loan payments going towards principal and toward interest vary as the loan is paid down. Early in the loan term, portions going towards interest are relatively high and portions going to principal are relatively low. So you take out a loan of, I don't know, $10,000 for buy a new motorcycle. You will note, and if you look at your loan schedule, every payment and how much is going what, you will notice that as your first payments, you're basically paying majority interest on that loan. You're not really paying a lot of principal. However, as you trend towards paying off the loan, each payment will go more so to interest to principal as principal drops and therefore interest drops. So you pay, if this is a motorized loan, you're paying the same amount, but the amount of interest that you would pay is decreasing because your principal is going down, therefore causing the interest to go down. I hope that made sense. So suppose you have a student loan totaling $7,500 when you graduate from college. Lord, wouldn't that be wonderful? The interest rate for said student loan is an APR of 9% and a loan term of 10 years. So pause the video. Make sure you know what those phrases mean before we go forward. That being said, what are your monthly payments? How much will you pay over the interest of the loan? And what is the total interest you will pay on this loan? Well, I gave you a bunch of numbers. Hopefully you pause the video, you know what those numbers mean, so you know why the 12, the 0.09, the 7,500, and the 10 are all sitting in the equation as they're sitting. Again, write the equation down, solve it in small chunks, continue rewriting the equation over and over again in those little tiny parts until you get to the end. That way the equation looks less daunting, you're less likely to screw it up. As shown here, drop, 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 go, go, go. We find out that our payment amount is about $95 a month. So you pay $95 a month every month for 10 years. That comes out to a payment of $11,401.20. Meaning your $7,500 loan that you took out is paid back with $11,401.20. Or another way to phrase that, you pulled out $7,500 and then you paid the loan company almost $4,000 for the privilege of paying them back their $7,500. Right? That's how that's how this game is played. Most everyone's got loans. No one likes doing it. But as we'll get into, there's ways to manage this ridiculous concept a bit better. So for the student loan, the previous example, this table here shows the amount of payment that's applied to principal. It's easy to use software to find principal interest payments with built-in functions, but this will work for now. So end of month 1, your interest of 0.0075 times your balance gave you $56.25. The payment towards the principal was $38.76. Meaning, again, notice here, that the new principal at the end of your first payment was $7,461.24. So your payment did not necessarily include, your payment of $95 did not go towards reducing your principal by $95. Your payment of $95 went towards reducing your interest, then reducing your principal. But if we look at month 2, month 3, step down this path, we do notice that the payment towards principal slowly ekes up, meaning the principal slowly deteriorates faster. And if we go down this, 30 months, you will find that these numbers sway more towards paying off principal. Cool. That was loans. What fun. Let's talk credit cards. Credit cards differ from installment loans in that you're not required to pay off your balance in any set period of time. That's the catch. Right? Instead, you're required to pay a minimum monthly payment. This monthly payment generally covers all the interest and very little principal. Interesting how that works. It usually takes a very long time to pay off a credit card if you only make the minimal payments. So, notice, again, take a second, pause the video if you want. That's the same equation, right? So, suppose you have a credit card balance of $2,300 with an annual interest rate of 21%. Big interest rate, right? Bigger than we've seen previous. You decide to pay off your balance over the course of a year. How much will you need to pay each month? assuming you make no further credit card purchases. So, yeah, balance 2,300. Big old interest rate sits looking at you square in the face. You want to pay it off the course of the year. That's 12 monthly payments. What do you need to do? Well, if we plug our numbers in, do our math, we find out that you need to pay $214.16 per month to pay off that $2,300 payment. And again, this is per month, right? So that number times 12 is larger than 2,300, right? So the credit card company made money off of you doing it this way. And I guarantee you, in this example, that minimum payment was not $214.16. That minimum payment was probably something closer to $30 or $40. Finally, we can talk mortgages. Mortgages come in many shapes and sizes, but they're all painful. A home mortgage is an installment loan designed specifically to finance a house. There's auto car mortgages, there's rent mortgages, boat mortgages, motorcycle mortgages. They're all essentially the same thing, but the people that determine them look at different aspects. Let's just say that. The down payment for a mortgage is the amount of money you must pay up front in order to be given the mortgage. So before the bank gives you money, you need to show that you have this much money. So the bank then gives you more money. It's part of the process. Closing costs are fees that you must pay in order to be given the loan. These include direct fees, such as appraisal and credit check, or fees that are charged as points, where each point is 1% of the loan amount, the discount point or origination fee. So you need, if you want to buy a house, you first of all need to show the bank you have enough money to put down a large enough down payment. That's going to be bank dependent. People usually say 15% or something like that, but it's all very bank dependent. Talk to your bank or your credit union. And then you need to pay the fees for the bank to give you money, which you will find that these concepts, these ideas, are less to do with the actual transfer of the money and more to do with they used to actually have to charge fees for people to do this work. But given our modern life with computers, these closing costs just kind of never went away. But that's another can of worms. So, mortgages, fun. Different types of mortgages exist. There are fixed rate mortgages. This is one in which the interest rate is guaranteed to not change over the life of the loan. And then there are, of course, adjustable rate mortgages, which is one where the interest rate changes based on other prevailing rates. When you hear about the Fed changing rates, interest rates and things, mortgages can be affected by that. In times of prosperity, rates go up so that banks essentially can make more money because people have more money to spend. In times of sorrow and woe, banks go down, interest rates can be dropped so that you're essentially encouraged to buy mortgages. If the mortgage rates are low and you don't think they're going to go lower, go for a fixed. If the mortgage rates are high and you hope they drop, go for adjustable. It's a tough call. You got to look at your crystal ball and decipher the future a bit. All right, let's do an example with mortgages. Great Bank, great name, offers a $100,000 30-year 5% fixed rate loan with closing costs of $500 plus 1 point. All right, pause the video, read that sentence a couple of times, make sure it makes sense to you. Big Bank offers a lower rate of 4.75 on said 30-year loan. But with Great Bank, closing costs are $1,000 plus 2 points. I should say Big Bank. I got to change that. So one option is you need a $100,000 30-year loan. Okay. Your choices are: do you want to do a 5% fixed with $500 plus 1 point, or do you want to do a 4.75 fixed with $1,000 plus 2 points? What do we want to do here? Well, let's plug the numbers in, find out what happens. What are my payments for each of these options? Great Bank, the 5% option shown here, plug it into your credit card calculator that we discussed earlier, your loan calculator, because a mortgage is essentially a fancy name for a loan, right? You have your amount, your principal of $100,000. Your APR is 5%. Paying monthly, so your N is 12. Over 30 years, Y is 30, giving you a payment of $536.82 for Great Bank's offer. Big Bank has a lower interest rate, so they therefore have a lower payment of $521 as opposed to $536. Cool. However, it gets steeper, right? So you save about $15 per month with Big Bank's low interest rate. Now you must consider the difference in closing costs. Big Bank charges an extra $500 plus an extra 1 point or 1%, which is $1,000 for the loan. Meaning, Big Bank requires you to pay $1,500 up front in closing costs before they give you the loan. Divide this into the time it takes to recoup the $1,500, you come out to about 8.5 years, right? So unless you are sure you'll be staying in the house for more than 8 years, you'd probably want to go to Big Bank because the upfront cost of $1,500 is not recouped until after 100 months of payments, at which point, if you continue paying on after that, the smaller upfront cost ends up being negligible. It doesn't even matter, right? You are saving money per month with Big Bank, but you are saving money with the lower interest rate shown here, as opposed to Grand Bank, Great Bank, Big Bank. Big Bank is less a month, but more upfront. So you need to decide, is the higher upfront cost now worth it compared to lower interest rates? And what this math is showing you here is that you need to pay about 100 payments in order to recoup that difference. As discussed a couple times already, there's a relationship between interest and principal in such that you start paying off more and more of your principal, less and less of interest as your loan term increases, right? Kind of went over this stuff. Here's an example for the question we just got done going over. For any month during a 30-year loan period, the height of the interest, or blue portion, tells you how much your $537 go to interest. So at 5-year mark, we notice that of our $537, only 153 of it is going to the principal, meaning a lot of it, we're still doing well over half, about 2/3 of mortgage payment is just paying off the interest for the privilege of owing the bank money. How kind of them. And we also notice it stays flat a lot longer than it stays narrow. Interesting. All right, let's go over another example here. Here we have rate approximations for ARMs. So you have a choice between a 30-year fixed rate loan at 4% and an ARM with a first-year rate of 3%. Neglecting compound and changes in principal, estimate your monthly savings with the ARM during the first year of your $100,000 loan. Suppose that the ARM rate rises to 5% by the third year. How will this affect your payment? So the ARM, remember, is the one that adjusts its interest rate, and the fixed doesn't. So the ARM was smaller at first and then grew past the fixed. So which one was worth it? Since mortgage payments are mostly interest in the early years of a loan, we can make approximations by assuming that the principal remains essentially unchanged, because you're not changing it a whole lot in those first periods anyways. So for the 4% fixed rate loan, The interest on a $100,000 loan for the first year will be, well, 4% of 100,000, right? About $4,000. There's $4,000 worth of interest accrued that you pay on that loan. With the 3% in the adjustable, well, it's $3,000, right? However, the adjustable rate will save you about $1,000 in interest during that first year, which means you're saving about $83 a month by going with the adjustable. By the third year, however, the rate reaches 5%. So the situation is reversed. The rate on which the ARM is now 1% point above the rate of the fixed rate loan. So instead of the ARM saving you $83 a month, you're now paying more by the same amount. So instead of saving $83, you're now paying more than $83. Moreover, if this interest rate remains higher, you will continue to make these higher payments for years to come. So the ARM has a risk to it. If the ARM's rate stayed low for a longer amount of time, that would have been a wise maneuver. But you never really know what's going to happen with these things, right? Hence, that's risk to borrower. So this is a very complicated, confusing subject. It's hard to cover in the limited scope of this class. And this class really isn't intended to cover this stuff, right? I care more so to understand how to do the equation and how to build the equation. And these are good examples of different levels of equations. You could think of it that way, as you've learned from the class, right? If this stuff is of interest to you, I highly suggest you do more work on it on your own. Go talk to your bank. Go talk to your credit union. They're willing to sit down and discuss these ideas with you. If you've shown to be a good consumer of the bank, they're more willing to play with you. A lot of this stuff really gets down to people skills at the end anyways, right? So that concludes this chapter. I thank you for watching. Hope things go with homework. If you've got any questions, shoot me an email, leave any comments down below. I will check them, and have a good day. Stay safe.